to The Retirement Architect. My name is Cynthia Defazio, and I'm joined today by David Reyes. And David is founder and chief financial architect of Reyes Financial Architecture. David, how are you today?
Good, I'm very good. How are you today?
I am doing fantastic, thank you. It's always a pleasure to spend time with you because I love the information that you provide to the viewing audience. I know people have so many questions today, obviously with so many changes happening in the world.
Yeah, hopefully for the better. But yeah, it's, love doing the show. It's been great. Lots of response. So we appreciate everybody calling. It's fun to chat with fellow San Diegans and help them out with, with what's going on. And it's definitely a challenging time. I think, obviously we had the election and all those types of things that are stressful, and COVID, of course. Yeah. But, you have a new administration, tax policy, what's going on with interest rates. I mean, there's a lot of different things happening. And so, I think now more than ever, we need some guidance. And so hopefully we can provide that for people. Sure.
What is the main question that you're being asked the most? If you had to pick one right now from your callers, from your viewers, what do you think that would be?
I think, well, really, it's about the markets. Yeah. You have two camps. Some people are just really super bullish and aggressive, thinking market's never going to fall. And the problem is this kind of bad behavior that the Federal Reserve and our governments, basically the market doesn't, they save it until they can't. And people forget in 2008, the Federal Reserve came in and did all the stimulus, and it took 5 years to get back to even. Sure. Not 5 months like this last downturn I call the COVID crash. So you have two camps of people that are really nervous that the market's so high, and then you have people that are, well, hey, now I want to be more aggressive, so that's not our style. We'll talk about a topic that I love called upside downside capture, in a way to try to get good returns without having to take on all this market risk. And so, we want to protect capital and grow capital, but mostly focus on cash flow, retirement income planning. So it changes the dynamics, but I would say mostly it's the market. David, what do you think is going to happen with the market and in my position properly?
Okay, let's refer back to that a little bit. What exactly is the upside downside capture, if you will? Because I've heard you mention that in the past. I'm sure viewers are wondering too.
Yeah, it's a term most people are not going to. It's one of those financial terms, financial ease, I call it. Okay. And upside, it's pretty simple. So if you bought, I was just doing some homework before the show, and since 1999 to 2019, the market was only up 6.1%. That's it. People think, 10, 12, 15%. The market doesn't average that over time. It just doesn't. Sure. If you go through cycles, I mean, we've had this bullish market for a long time now, but you're talking 6.1% since 1999. And I always talk about, we only need about a 5 or 6%. But the point is, how did we get there? If you're invested in 1999, you went through 50% corrections in the market to get 6%. How smart is that?
Exactly.
That doesn't make any sense.
Exactly.
So there's got to be a better way, and there are. So what upside downside capture is, think of it this way. So what we focus on is what upside do you need versus the downside to get good returns. So there's a study done by Crestmont Research, a firm I follow quite a bit, and they did a study for the last 50 years, since 1969, that if you got 30% of the upside and none of the downside, you actually got stock market returns. You got that 6.1%. Theoretically. Okay. If you got 40% of the upside and 20% of the downside, upside capture, downside capture. So you actually got market returns. If you got 60% of the upside and only 40% of the downside, you actually beat the market. So what people focus on, if we're invested in the market and it goes up 10%, we get 100% of the up, and it goes down 10%, right? We're zero. We have nothing. So we got 100% of the upside, 100% of the downside. Okay. So managing that risk management, trying to focus on getting reasonable rates of return when the market's going up, but focusing on risk management when the market is falling. I want to get lesser and lesser and lesser of those downside. Then I can have a portfolio that's going to look more like this instead of like this. Sure. And that's just kind of my passion when it comes to managing clients' assets, above and beyond using other assets like real estate or annuities. But managing equities, whether it's mutual funds, ETFs, stocks, is how do we get that in our favor? How do we manage money to where we can participate in the market upside, but make sure we're disproportionately investing on the downside, meaning that I only want 25, 35, 40% of the downside. And so that served us well. And so I focus on, again, upside downside capture. Just think of it, hey, I want to get some upside, but I don't want to participate so much on the downside. Sure. And the amazing number when I was looking at this is if you only got 30% of the upside and none of the downside, you actually got stock market returns. Wow. Over the last 50 years. So it's pretty amazing. And there's strategies you can use that can, such as annuities we'll talk about later, that have principal guarantees. You can get decent upside returns, but no downside. So there's many ways to get there, but just as an advisor and a retirement planning expert, I focus on downside risk management. I think that's what's missing. Most clients don't have any, they're just going to go up and down with the tide.
Yeah.
And that's a dangerous game to play.
Well, it is, David, especially when you're approaching the retirement years, or if you're in the retirement years. I mean, the last thing you want is to be relying on the stock market for all of your income.
Yep.
So you have to manage it properly. But without having someone like you in the driver's seat, people wouldn't know what they should be doing or not be doing.
Yeah, and again, we get so much caught up in what's happening day to day with the markets. And I would say the majority of people don't, and that's good. But you have people that do. And so you kind of have to show them a different way, retrain their mind a little bit about, and I'll use that example of upside downside capture. We'll use products like, principal guaranteed investments that participate in the upside. If we can get 4, 5, 6% returns over time and have no downside risk, that's probably a good idea for some of our portfolio.
Sure.
As opposed to a bond that maybe pays us 1 or 2% of the maximum, but we have the volatility. So there's just many, if you start teaching people and they're open, I always say if you're open, then I can help you. If you're not, then you don't need me to lose your money, right? When the market crashes again. But most people are very open to what are some ways I can protect capital, I can grow my capital, because we want to make money, but more importantly, focus on having lifetime income that we can't outlive. And with the caveat, as you know, I talk a lot about inflation, with can I increase my income over time? And so that's a whole other topic. But there's lots of things that go into that you have to know what you're doing, in my opinion, to be able to optimize that.
Sure. David, who is your ideal client? Who does your firm typically help the most?
Good question. Our average age of our clients probably about 67, give or take. I'm getting older; they're getting older.
Sure,
I think I
we
mentioned
all
before.
are.
I think when I first started in '95, I was 27. My average client was about 50.
Yeah.
So 10, 15 years from retirement, and now most of my clients are just about to retire or already retired.
Yeah.
Our minimum as a firm, our minimum assets is $500,000 of investable assets. So that's 401ks, IRAs, savings accounts, things like that. Not real estate or not home values. Investable assets, and we have firm minimums, so we do a lot of planning. And we're a boutique firm here in San Diego, been for a long time, 25 years. And so I always say I'll help everybody if they want me to give them some advice, answer a question. I just can't help everybody as a client. And so we do our best to do that. But our clients are typically people that have been good savers. Most people that have a lot of money haven't been great investors, so to speak. They've just been really good savers. And continue to save. But the problem is when you have all this money, we just want to make sure now, how do we protect that? Because it's sacred money. We can't just go replace $500,000, $1 million.
Exactly.
We lose half that money in a bad market. I mean, when do we get that back?
Yeah, exactly.
So our ideal client is somebody who's conservative, wants to protect their capital, wants to focus on creating income and have conservative growth for the portfolio. Okay.
Well, David, this is the perfect time for us to open up the phone lines to the viewers at home. Would you agree?
Yes, thank you.
To our viewers at home, the phone number on your screen to call is 866-739-3775. We know you have a lot of questions about how to retire with confidence and retire comfortably. David and his team have the answers for you. And for the next 10 callers today only, he is offering you a complimentary consultation. That number is 866-739-3775. Again, 866-739-3775. We have to take a very short commercial break, but when we come back, we're going to have some more questions and answers with David about retirement, so don't go away.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to The Retirement Architect. My name is Cynthia Defazio. I'm joined today by David Reyes, and David is the founder and the chief financial architect of Reyes Financial Architecture. So I love talking to you, David, about the importance of planning properly for retirement. And I know you're very passionate about taking a more conservative approach, if you will, because obviously people have worked their whole lives to get to where they are today, the retirement years. The last thing they want is to take a risk of losing a lot of money. So on that same vein, I want to talk to you a little bit right now about real estate. Because as we know, nationwide in certain areas, real estate prices are just going through the ceiling, if you will. In your opinion, how much of your client's portfolio should be in real estate?
Well, we typically, as a firm over the years, I've used real estate as an asset class for going on 2 decades now, a long time. And I would say real estate, not a real estate mutual fund, I'm talking about a hard asset real estate where you actually own physical real estate through different structures that you can do that with. And you know, typically we like to see up to as much as 20%. It depends, not every client has that much, but that's probably that maximum 20%, 20, 30% would be really on the high side. But the fact is that real estate's a good diversifier. I've talked a lot about inflation. And when I'm talking about real estate, I'm talking about really niche real estate. Our favorite is what's called necessity-based real estate. And what that is, funny term, is that necessities, pharmacy, grocery, discounters. So we have an investment our clients have been in for a long time, which the tenants are Kroger, CVS, Walgreens, Dollar General, AutoZone, Napa Auto Parts, Tractor Supply. Very, very conservative. In fact, over COVID, you had no defaults at all. In fact, the portfolios actually went up in value. So what an amazing concept. You owned real estate, you made money. It typically pays, over a 6% distribution rate. But the good thing about real estate, especially today, is number one, it's a diversifier. So instead of owning, it's another piece of the puzzle we can do to diversify out of the stock market to reduce volatility, get cash flow that we need so we can get 5 or 6% distribution rates as income without having to sell our portfolio assets. And number three, one of the best assets to own in what I consider an inflationary environment is real estate. So really, real estate is, if you own the right kind of real estate, we're not trying to speculate, we're talking about capital preservation and cash flow. And people don't realize over the last 20 years, real estate has been one of the, I'm talking about real estate investments, security investments, have been the best investment to be in. And second, I think it's 11% real estate has been up since the last 20 years, since 1999. Gold is number 2 at 6%. And the stock market about 6.1%, and most people own no gold or no real estate. So those are things we can do besides bonds, which most people own too many bonds that don't make any money and are risky. So there's just a lot of ways to even allocate a little bit of money to help to if clients own zero gold in their portfolio, but now they own 3 or 4 or 5%, or they own no real estate and they own 5 or 10%. Now you start chipping away maybe some of that bond portfolio that will allow you to have diversification and also cash flow that we need and the inflation protection. So I love real estate as an asset class, but it has to be the right kind of real estate. Again, we're not speculating. We want conservative, big, name tenant type of properties that we're talking about that have consistent cash flow, those types of things. And so I just like it as a diversifier. Again, I really like it now as real estate in general as an inflation hedge as well.
So David, let me ask you, obviously talking about that as being part of the portfolio, what else would be a diversified portfolio, if you will? What other pieces and parts would go into that?
Well, typically, if you were imagining like a pie chart, I wish I had a whiteboard here. I know we're going to get one here pretty soon. I would draw a circle with basically 3 areas. The number one would be equities, right? So let me say a third equities, and just to make this up, it's not exact, but equities, real estate, and then I would use guaranteed lifetime income products like an annuity, something like that. So, again, the A word, people say, oh, annuities, right? Well, annuities, I've used them for 25 years in my practice. And if you have the right types of annuities, low fee, good companies that have principal guarantees, maybe conservative growth, and lifetime income benefits as well, that can be a good piece of the puzzle. So on a growth side, if we can get 3, 4, 5, 6%, or we can get lifetime income of, let's say, 5% guaranteed for the rest of our lives, that's a great diversifier because, again, we're not tied to the stock market. We have principal guarantees. So again, chipping away, if we're thinking somebody has a half stock, half bond portfolio, and now all of a sudden I go, now all of a sudden I put guarantees in there, that 20% guarantees, 20% real estate. Now all of a sudden maybe I own 10% bonds instead of 50% bonds. And now I'm getting a good cash flow, and I have some diversification and some guarantees. That's how I really look at things. And the beautiful part is I built the firm for my clients, not for me.
Okay.
And so these are things, if I'm retired and I want to protect capital, diversify, reduce volatility, create income, I think you really need to introduce other asset classes to really accomplish that.
Okay.
And so it's very methodical. Everybody's different. You'll hear me use the term I've talked with you, begin with the end in mind. So the end is how much income can I create the most safe way possible, the most amount of income, the least amount of risk, and never run out of money.
Yeah.
Again, the most amount of income, least amount of risk, and never run out of money. And so to get there, in a high level where we want to get our goal is always 5% cash flow.
Okay.
We want to produce 5% cash flow. So if you have $1 million, I want to create $50,000 a year that we can never outlive for both you and your spouse.
Okay.
So to get there safely, you have to do things differently than you did 20 years ago. It just won't work anymore because mostly the bond market is not going to cooperate. There's no income, right?
Sure.
So that's a problem.
Sure. And I love that you said the fact that we have to consider where we are today, because obviously we've talked about this before. You're very concerned about inflation going forward.
Yep.
Let's talk a little bit about that again today in this segment in case someone's watching for the first time. Why do you feel concerned about inflation, David?
Well, when you go through the pandemic that we've gone through, we're going through, hopefully we're on the other side of right now, who knows, I hope. But the fact is that there's been so much stimulus. I mean, our national debt, our federal deficit in 2008 was $10 trillion. It's probably going to be $30 trillion by the end of this year.
Wow.
We've already added $4 trillion in the last 12 months, 18 months, and they're talking about another probably between the new stimulus package of $1.9 trillion, and they're going to introduce Biden's going to introduce a stimulus bill for, an infrastructure bill, probably $2 trillion or more. You're talking another $4 or $5 trillion, and that'll put us above $30 trillion. I mean, this is just, I call it guerrilla math, right? It's like, how do you calculate these things?
Right.
And so with that said, that's all inflationary. And you've probably seen it. I mean, the grocery prices are higher, commodities are higher, home prices are higher. We talked about lumber. Lumber prices have doubled in the last year.
Absolutely.
Home prices aren't going anywhere. I mean, home prices are going to stay elevated just because the material costs are so high.
Sure.
So my concern is for the first time in 2 decades that we are going to have inflation. And so you need to understand that, and to understand that, you need to say, well, how do I solve the problem? And to do that, we use 3 main principles. Number one, we like dividend paying stocks that have increasing dividends. So we want to get our dividend portfolio is average about a 5% distribution rate. So there we go. We get some income, plus we get increasing income with the companies that we want. We want to use annuities. I really like inflation protected annuities, which will allow us to have increasing income over time. And of course, I love real estate.
Okay.
And so you really, again, to deal with inflation, because inflation is a bond killer.
Sure.
I think I mentioned in a prior show that for the first time, one of the softwares that I use for retirement income planning, they actually have a negative yield, negative return, because they have inflation in there at 2% as their default. That's the minimum. And the bond income is 1.5.
Wow.
So it's negative 0.5%.
Yeah.
So basically you're going to fail if you just own bonds in the portfolio. So it's really the unintended consequence of what happens when you have low interest rate policy.
Okay.
It really hurts retirees and savers, and then they tend to make some poor decisions, maybe get more aggressive with stock markets because they're not making any money in the bond market.
Yeah.
So inflation is a problem. I don't think it's going away. The current administration and the construct of Congress and the Senate are going to be very pro stimulus, which is fine. We need a lot of it. Depending on your politics, how do we get there? Right.
Yeah.
That's the difference.
Yeah.
But it's a concern. It's something that I think retirees need to really focus on and have a game plan for.
Sure, absolutely. Well, David, this is the perfect time for us to reopen up the phone line to the viewers at home. To the viewers at home, the phone number on your screen to call is 866-739-3775. We know you have a lot of questions about how to retire comfortably and with peace of mind. What David is offering you today is a complimentary consultation, and all you have to do is pick up the phone and call 866-739-3775. You've worked your whole life to get to the retirement years. You deserve to retire with peace of mind and with comfortableness, knowing that you can weather any storm, and David can put a plan in place that exactly suits you to just that. Again, 866-739-3775. We'll be right back after this very short commercial break.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to The Retirement Architect. My name is Cynthia Defazio. I'm joined today by David Reyes, and David is founder and chief financial architect of Reyes Financial Architecture. Saying that all so fast.
No, that's all right. You did good.
Thank you. So we have a lot of viewer questions that have come in through the weeks, David, and obviously people are just so hungry for the information that you're providing to them, but it seems like a lot of them have been centering around annuities. So there's just a couple I want to ask you, if you don't mind.
Sure.
Just to get through a couple.
Yes.
It says, David, I have a question. Why do some annuities seem to have a negative stereotype?
That's common. I mean, I've used annuities for 25 years. So my first half dozen years in the business, that's all we did. And then over time, we started doing other things like, stocks and mutual funds and real estate and things like that. So I have a pretty good understanding of annuities. And we use them as an asset class. So for some people, they're really appropriate, and some people, they're not.
Okay.
And so I'm agnostic about it. I have a saying, I don't care what it's called, I care what it does. We get caught up in labels with life and investments as well. They're no different. And so, annuities can be a really good opportunity. The annuities that you get a lot of the bad press are typically variable annuities that have variable means variable. They can go up and down. Okay, there's no principal guarantees. We don't use variable annuities, so principal risk is a problem. But usually the fees are pretty high in variable annuities, sometimes as much as 3, 4, 5%.
Okay.
The annuities that we use are going to be mostly zero fee. If you want an income rider, you're talking around 1%, give or take. So reasonable. I mean, the average mutual fund cost is going to be around 1%.
Okay.
So if you understand them and you can use them as again, what does it do? Well, if I can give you principal guarantees and we can get 3, 4, 5%, over time consistently and not have any principal risk, is that reasonable for a piece of the portfolio? Again, as opposed to a bond that pays us 1%.
Sure.
Or if I want lifetime income benefits and that can distribute me out 5, 6% over myself and my spouse's lifetime, is that something that sounds good? Yeah. You slap the word annuity on it, some people go, oh my gosh. Again, I'm agnostic about it. My job is as an advisor to protect and capital and maximize income and grow capital conservatively. So annuities, have a place in there. And some clients really embrace them once they understand them. But more people, I think I read a study just last year that I think about 70% of people that bought annuities are more than satisfied with what they purchased because it did its job. It protected your principal and it gave you lifetime income or conservative growth. Then it did what it was supposed to do. So most people are open to it if they understand it. And again, I'll introduce it if I think it's necessary.
Okay.
If it's not necessary or I don't think it's warranted or the client's not really that keen on it, then of course we won't use that. But usually if it's needed and the client's open to that because they want to protect what they have.
Okay, so again, it's not a one-size-fits-all. It depends on someone's individual dreams and desires for retirement. All right, this is a great question too. It says, David, can you help me understand what exactly is a fixed indexed annuity?
Yeah, so the key word is fixed. So first you want the word fixed. Fixed means principal protected. Okay. Variable is not protected. So we want principal protected, right? And then most fixed annuities, you can get zero fees if you're not using have an income rider. But fixed index is just tied to an index like the S&P 500 index. So it's fixed, and the return is tied to an index. If you get a fixed annuity, it's just going to be, let's say 1%, 2%. It's going to give you a fixed payment or fixed distribution rate or fixed income.
Okay.
But index at least gives you the opportunity to be tied to a stock index that maybe give you a little bit more growth than you would typically get with a fixed annuity that's paying just an interest rate. So again, fixed is good because it's principal protected, and index means it's tied to a stock index, which can give us some conservative upside gains.
Okay, thank you so much. This is a great question too. It says, David, is it ever too late to get started on a retirement plan? I am 3 years away from retiring.
3 years is good.
Okay.
A lot of people come to me, you know, David, I'm retiring next week. I mean, that's common.
Yeah.
I've had 2 clients just this year already that I just off the top of my head in the last, you know, that are retiring the next couple months. And that's not uncommon. Now, that's not ideal because they don't have an income plan for sure, right?
Yeah,
so 3 years out,
definitely.
that's great. I mean, that you're doing good, you know, better than a lot of people. And so, yeah, today is even after you retire, it's a good time to do an income plan.
Yeah.
And like I said, probably the majority of our clients are already retired. So it's about optimizing. But yeah, if you're 3 years away from retirement, it's always a good idea to sit down with a retirement income planning expert.
Sure.
There's a big key differentiation between a broker who's managing assets and somebody who's an expert in retirement income planning.
Yeah.
So I would advise that person to find somebody like ourselves or other firms that can do that for you.
Definitely. Well, we only have a couple minutes left, David, but I wanted to ask you, because the phones have been going crazy today
Yeah.
as I'm sitting here asking you questions. I'm watching them light up. What does it feel like when someone comes into your office for the first time, in your words?
Well, hopefully comfortable because, you know, our office environment is very relaxing. We try to make it spa-ish, right? Nobody wants to
Okay.
go into some banker's office, right? No, it's the opposite of that. So you have great staff, very blessed to have the staff we have. So I would say, you know, we just have conversations with people. So I say it's a conversation. There's no agenda. There's no here's the rules. Here's the outline. We talk. Because it's always funny, if I'm talking to you for an hour and a half, it's the last 15 minutes of the conversation that we learn everything you need, you know, that starts, the light bulbs start going off.
Yeah.
I've said before, everybody has a story. If you get to know the story, you can, of that person, you can understand the story of their investments, and you can build a better plan that way. So
Sure.
just having conversations with people and really deep conversations about what they care about, their kids, their legacy, if that's important to them, what they want to do. COVID's kind of challenged that a little bit because people want to do all this stuff, but they haven't been able to do anything. So the fun part's going to actually be hopefully people actually, you know, doing the things that they say they want to do, visiting their
Definitely.
grandkids,
The bucket
traveling.
list, yeah.
So I'm excited about that opportunity.
Well, David, with less than a minute left, any final words of wisdom you want to impart on the viewers today?
Plan today.
Plan today.
You're the write-in for the question about 3 years out. Is that a good time to get get a retirement income plan? Yes. So do it now.
Yeah.
It's important. It's probably the most important thing you can do, and it's one of those things that gnaws at us. So if we can get rid of that, right, we can maybe enjoy ourselves a little bit more, not be so stressed about our retirement.
Absolutely. Well, David, I can't believe we're to the end of another amazing show. So thank you so much for being here again this week. To the viewers at home, thank you for spending time with us this week. That number to call is 866-739-3775. We look forward to seeing you back again. Be safe, be happy, be blessed, and thank you again for watching.